Insider trading, is it the scourge of the markets or completely harmless? Here to give his opinion is Tim Harford, author of The Undercover Economist Strikes Back. Tim, insider trading, is it as bad as it's made out to be?
Insider trading is one of those things that has a real appeal to financial journalists like me and to regulators and to anyone who wants to get cross about the city or Wall Street, because it's a financial crime that seems to be really easy to understand. And to be honest, there aren't very many financial crimes that are easy to understand. Insider trading, these guys knew something and they took advantage of that secret information to make money and took advantage of other people. And it just seems so straightforward. So that's why I think it's very appealing to write about it and talk about it and engage in these big whodunits. It's just one problem, which is actually quite hard to figure out what harm insider trading causes. I think one can make a case that it causes harm, but it turns out to be not as straightforward as you might initially think.
Following on from your article, what were your initial thoughts when you went into this article, and did they sort of change following research?
Well, I discovered new ways in which insider trading can be harmful, which is interesting, but I also had my initial view confirmed, which is that the reason people think it's harmful is not the reason they think it's harmful. So the reason you think insider trading is harmful before you have really sort of thought deeply about it is, well, you want to buy shares. I own shares in a particular company, and I know that the profit report is just about to come out, and the profits are bad, and the shares are about to fall, and I sell those shares to you, and then the next day the results come out, and the shares fall in value, and you've lost money, and I've taken advantage of you, and that seems to be straightforward. But when you think about it, you go, well, hang on. You were going to buy those shares anyway. If you didn't buy them from me, you'd have bought them from somebody else. I didn't lie to you. I didn't commit any fraud. I didn't tell you that the profits were going to be good. I didn't phone you up and solicit your custom. It was just you tried to buy shares and you actually got a better price for the shares you were going to buy anyway because I was in the market selling them. So what's the harm? And I think that's where you initially start and you go, gosh, this is quite tricky. So what might the harm be? I think one form of harm that there is potentially in insider trading is the incentives to management. So if you are an insider in a corporation, you know whether the shares are going to go up or down. If you were able to just constantly trade on that basis, well, maybe no harm in that. But then you actively acquire an incentive to make the shares of the company fluctuate up and down. You need to create surprises, good surprises and bad surprises all the time, because every time you create a surprise, there's a new opportunity to make money from your insider trading. So it turns out that the real harm, I think, the real worry is not the insider trading, it's the way insider trading might generate a profit opportunity that might itself then be damaging. And I think that's a broader lesson for the way that we think about the city and regulating financial activity, the way we think about regulating investment banks. Often it's not the sort of the superficial headline problem that is actually the problem. So for instance, with performance-related pay, the problem with performance-related pay was not, people were being paid too much money or that people were being paid money and they didn't deserve it. The problem was, and economists knew this beforehand, performance-related pay creates certain incentives to take all sorts of the wrong risks. So we're actually paying people to cause damage. That's the issue. So there's a broader lesson here. It's not just about insider trading.
All things considered then, do you think that maybe insider trading should be legalised to a greater extent? Because then I think other people could sort of almost take advantage of this as well.
Well, I think there are no simple answers. There is certainly a case to say that insider trading is really a civil matter. It's a matter for an individual company's corporate governance policies, and that individual companies should take a view as to whether insider trading should be allowed or not by their directors, because that's fundamentally the issue, what their directors and their managers go on and do if insider trading is allowed. And to be honest, I suspect that most large companies would ban it. So I think there is a good case for that it's an internal corporate governance matter. I think the main case for keeping it illegal is just to save trouble and to say, well, I just assume all companies would ban it anyway, so who cares? But that case is not as strong as we might think. When you think about it, actually, there are all kinds of insider trades that take place every day that never get punished. They're the insider not trades. So if I own shares and I'm about to sell those shares because I would like to buy a yacht, because I run a company and buying yachts is what I do, and I happen to know that profits are good and the share's about to jump in value, I simply failed to take action. I would have sold the shares, I don't sell the shares, then the shares go up in value, then I sell them. That's insider trading. No one can find it, no one can punish it, no one can prove you were ever planning to do anything else. So it can't be regulated. But half of all insider trades have got to, by sort of pure sort of logical argument, have got to be the trades that don't happen rather than the trades that do. And they're legal because there's nothing you can do to stop them.
People are more savvy now when it comes to financial markets. So is the line being blurred between insider trading and people now just doing more research or being more aware?
Certainly there's a less straightforward line between amateur traders and professional traders, but I still think the professionals are always going to have an advantage. And I always advocate just a very simple, humble strategy. I'm struck by the investment performance of the great John Maynard Keynes, the guy who invented macroeconomics. Had an absolutely terrible trading record for years when he was trying to use his macroeconomic expertise, when he was trying to time the market and get in and get out, and be very clever and forecast when the market was going to fall. If anybody could have done it in the world, it would have been John Maynard Keynes, and he just couldn't do it. And then after about 8 years of this, he just changed his strategy and went for a much more Benjamin Graham, Warren Buffett, almost passive investment, but value investing, just looking to buy and hold stocks that you understand, whose management you trust, really sort of simple, no-frill stuff. And just as Benjamin Graham did, just as Warren Buffett has done, achieved tremendous rewards. So if John Maynard Keynes cannot make macroeconomic forecasting deliver investment performance, then you can't, I can't, I don't think anybody can. So maybe we all need to just calm down and show a bit of humility.